We begin with a dire warning from the UN Conference on Trade and Development. It says the way conditions are looking now, the global economy is heading for its worst downturn in recent memory. And it's pointing the finger at central banks in rich nations. UNCTAD says in the bank's aggressive campaign to fight inflation, they're squeezing the financial arteries that are vital to the health of the rest of the world. In a report, the UN agency says the global economy is now at risk of falling into its worst recession in recent memory. It's a slump that could be worse than the financial crisis in 2008 and the crash caused by the COVID-19 pandemic. The UN says current central bank moves could cost developing nations $360 billion.
We do not believe it is possible to bring down prices by relying only on higher interest rates without generating a recession. The world is facing falling real wages, fiscal tightening, financial turbulence, and insufficient coordination. In this context, excessive monetary tightening could bring a period of stagnation and economic instability for many developing countries, and no doubt also for some developed ones.
So what exactly is causing all of this turmoil? It starts in the US, where the Federal Reserve has raised its benchmark rates from 0 to 3% with the aim of taming inflation. Other major economies have followed suit to keep a lid on their own price pressures and protect their currencies. Just this week, central banks in Australia, New Zealand, Iceland and Israel further tightened their policy settings to keep up. The International Monetary Fund says central bankers have their hands tied.
We do need central banks to act decisively. Why? Because inflation is very stubborn. We see now secondary impact of energy and food prices into core inflation in many countries. And if it is not stopped in its steps, it is bad for growth and it is very bad for poor people. Inflation is a tax on the poor. So you have monetary policy putting a foot on the brakes and fiscal policy putting a foot on the accelerator.
Well, for more, let's go to Bruno Verstraete. He is the chief economist and a partner at Lakefield Partners in Zurich. And here on set with us is Taha Arvas. He's an economist and an adjunct professor of finance at Boğaziçi University in Istanbul. A big welcome to you both. Bruno, if I could begin with you, it really is a dire warning from the UN agency UNCTAD, isn't it? That the way things are going, we could see a recession that's worse than the one we saw during the 2008 financial crisis and even worse than the worst lockdowns of 2020 during the pandemic. Do you agree with that assessment? And what's behind that, do you think?
Well, I think depending on how far the Fed goes, it's clearly something which entails that danger, mainly because the leverage which is standing out there has been a multiple of what was the case in 2008. And another thing one shouldn't forget is that the balance sheets of both the central banks and also the companies have really gone to levels which are impacted much more by any interest rate increase as we see them today. On top of that, of course, you have the other side, which is the spending power of the consumer, which is reduced. So you have a double effect in that sense, interest rates going up and the consumption going down, which might actually lead to something which is very deep and unseen before.
Taha, the idea of raising interest rates really is the ultimate bitter pill, isn't it? Because the basic idea is that you raise interest rates, borrowing is more expensive, thereby people have less to spend. Jobs may also be lost in the process, but that will ultimately is hoped to reduce demand. It sounds like a really painful way to cut inflation, and it's not necessarily the best way, according to the United Nations.
Not only is it not the best way, there's no proof that it will work this time, because we're talking about, for example, the 2008 Great Recession, so-called, the amount of money in the system, money supply from then and now, if we look at the quantitative easing measures, is a factor of 10. We thought $1 trillion was a lot of money in 2008. Now we're talking about 10 times that amount of money. So no one in the history of the world has ever raised interest rates in such an environment. We have no experience with that. If we look at what the Fed did last year, Jerome Powell said 20 times inflation is transitory, transitory, transitory. And now the Federal Reserve, including just yesterday, said we made mistakes. It wasn't transitory. We should have started raising interest rates much earlier. And all these other countries, the euro is down at all-time lows, the pound sterling is down. All these countries who follow the traditional method see inflation spiking, including the United States. So the question is, bitter pills ultimately work. Maybe this is a pill that won't work. And then we're going to have to switch gears and we'll see what happens, I guess.
Bruno, turning to you now, we heard earlier there from the International Monetary Fund, who admitted that it really was a hard balancing act, and we know the IMF is famous for imposing really harsh austerity measures in order to get economies' finances back in order. So how do countries weigh up this balance, do you think? Should they continue to raise interest rates, even though, as UNCTAD says, it might cause a lot of pain for their economies, but also for developing economies?
Well, what we see now is that there is a shift from the monetary stimulus, which is actually breaking on two sides, not just on the interest rates, but also on the quantitative tightening, which is clearly deteriorating. And that is now shifted and compensated to a large extent by fiscal stimulus, where the politicians are actually handing out checks to compensate for that lost spending power. And of course, if you look at that, having again an increase in public debt at the time where interest rates are going up, that is something which could have long-lasting repercussions all over the globe, because the more money that is there to be financed, the more interest rates need to go up in order to get the money. And that could lead to, in the end, a bankruptcy of countries.
Incredible. Taha, before I pose my next question to you, can we take a listen to some three different viewpoints from three citizens from three very different economies? Let's listen.
We have been forced to not heat our houses, to not move around by car, and to reduce the amount of food we buy.
This cost of living crisis is killing us. It's killing us all, not just me, not just my friends. It's affecting people's livelihood, it's affecting their mental health.
Energy bills are up 60%. It is not possible for people to pay. Once again, in Italy, we young people and the working classes have to pay for the choices of the criminals who govern us.
So Taha, some very strong views there, and views that are really held by potentially millions of people around the globe in all sorts of economies. So how do you think governments should be dealing with this issue of inflation? If raising interest rates isn't necessarily the one-size-fits-all policy, what else should be happening?
So that's a $10 trillion question. I think the first thing that needs to be happening is not to be saying, and because it offers a false sense of hope to everyone, that this is the rule, the Taylor rule, so-called, is you increase interest rates by inflation. Well, that's not happening anywhere in the world. We saw the Bank of England balk last week, and Australia balk this week at raising interest rates. I mean, yes, we can potentially stop inflation if we have unemployment. If you look at if you hear Larry Summers, the former Treasury Secretary of the United States, he thinks unemployment has to double for inflation to slow. That means tens of millions of people will be unemployed. Who's going to pay for their unemployment costs? Governments are, again, citizens are. So the question is, I think what we have to realize is we have to be sober in the fact that this is something we've never seen before. This is the perfect storm. Economists need to get together and realize alternative steps need to be taken, and that just raising interest rates isn't going to work by itself. And we've seen that Australia and the UK have already accepted that.
And Bruno, the last question to you. We know that a lot of central banks will ultimately take their lead from whatever the US Federal Reserve is doing. What do you expect the US Fed to do going forward? Are they going to continue raising interest rates, do you think?
I think they will. They will until they see the objective return coming back. There's one good side of it. Once the economy really slows down, they will have much more leeway to be able to reduce the interest rate. So in that sense, I think they're in a better position than, for example, the ECB. At the same time, of course, the strength of the dollar is also helping in order to reduce their imported inflation, which is not the case again in Europe. So I think the currencies should be and will be looked at as part of the decision-taking process in the end as well.
Okay, on that note, Bruno, Verstraete, Taha, Arvas, thank you very much again for joining us. Appreciate it.
Thank you.